Those who are listening to Prabhakar for the first time, we had two, three sessions in the past, and those were very interesting sessions. So, if you are yet to have a look at those sessions, so surely those were recorded session and are available on my YouTube. So, definitely you guys can check those sessions. So this session is again in continuation with that session, and I sincerely believe that you guys will enjoy this session. And initially, like after the monologue and a round of questions from my side, I'll open the floor for everybody to ask questions. But again, please consider this session as an educational podcast wherein the knowledge being shared with the examples for study purposes only, and by no means if we discuss any name is a buy sell or a hold recommendation. Vakar, we can start so people will keep on joining meanwhile. So guys, more introduction sir will help ourselves, but again, sir is a fund manager at Samviti Capital, and recently he had shared the performance card of his venture, and that was really interesting and very promising. So definitely look forward to more great work from Prabhakar sir, and his approach has been different from others, but has been very rewarding in the sense that the returns are, I mean, it is conspicuous from those results how much of hard work he does and the diverse approach he uses. So, sir, over to you. I would request you to give some background about your Samviti Capital, and then we can proceed around the topic for today.
Thanks, Prince. I hope I'm audible and clear.
Yes, yes, properly. And meanwhile, our audience can also confirm in the comments so that we can also know. You can start, sir. In case there would be an issue, I'll come to you.
Sure, sure. So, good evening, everybody. Quick introduction. My name is Prabhakar Kudva. I am a director and fund manager at Samviti Capital. So, primarily, we run two products, a PMS and a Category 3 AIF. And we've been doing this in Samviti for the last 10 odd years. Fund management, of course, is what I do day to day. But what I also love is to constantly learn about the markets, and wherever possible, try to teach others. So it is in that same spirit, I agreed, to do this space with Prince. And the topic that we chose today is something which should be quite interesting to you. I mean, it has been quite interesting to me while I have spent some time, digging around and digesting this idea. So the topic is anatomy of a multi-bagger. So most of you have, I'm sure are in the markets. You know what a multi-bagger is. So Peter Lynch coined this term, and anytime a stock makes 2x, 3x, 4x, 5x, 10x return, and sometimes even 100x return, we call those stocks a multi-bagger because it multiplies your money, several times. Uh, of course, the main reason why we are all in the market is, that in our lifetime or, in our investing lifetime, rather, we should at least make a few multi-baggers because just, a few of them can literally change your life. Because by definition, a multi-bagger multiplies your money several fold. So this is a topic which should be not only interesting to all of us, it's a topic that we should all spend a lot of time thinking about and learning about because finding one or more or several multi-baggers is what our goal should be, being in the equity markets. So I, have been, in the same spirit, I have been studying this topic. I've looked at several multi-baggers. I've looked at a lot of history around multi-baggers, primarily in the Indian context and to some extent, in the US context also. But today, primarily, we'll be talking about the Indian context. So there are three parts to what I want to say, right? So first is, to identify what are the ingredients of a multi-bagger. So if you think of multi-bagger as a recipe, then what are the ingredients or what are the core situations that need to be in place for a multi-bagger to potentially happen? The second, of course, is the catalysts, right? What are the catalysts? Once the conditions are in place, what are the catalysts that lead to the beginning of a multi-bagger journey? Third, of course, is where do these multi-baggers hide? What is the universe where these multi-baggers hide? And finally, of course, is what the outcome. When all three of these things come together, what does the outcome look like? So these are the four, categories or the four steps in which I have broken down this short talk. And briefly, I'll probably speak about how to construct the portfolio in order to take advantage of a multi-bagger. Because the multi-bagger journey is not a journey of a few weeks or a few months. Sometimes it's several months to several years. So how do you construct a portfolio to ensure that you participate in this journey of a multi-bagger? So let us start with the first, the first stage, which is to identify the ingredients or identify the underlying situation where you find multi-baggers. And all of this, I have kind of found out basis my own primary research and of course by standing on the shoulders of several giants, books and other interviews of so many successful investors. By no means is this a complete discussion, and I hope people understand that nuance, because in a short period of time you cannot have, cannot cover all the nuances or all the context. So so take it as a directional thing, take it as something which you can dig more deeper into, in your own journey and in your own study of multi-baggers. So there are a few, very important ingredients that I've seen in many multi-baggers, the common themes, so to speak, right? So one of the most important ingredient or one of the most important scenarios that you need to make a multi-bagger is nothing has something that has nothing to do with the stock. So the most important ingredient of a multi-bagger is actually a bear market or a deep correction, because a bear market and a deep correction ensures that the stocks are down in the dumps. Everybody who had to sell has frustrated and sold out, and this absence of selling pressure or this absence of supply allows a stock, of course, when all other conditions fall into place, this deep undervaluation, this deep absence of supply, absence of sellers, frustration allows a stock to really go up multifold whenever the right catalyst enters. So you would have seen this as recently as in COVID. If you take out the last few years and if you start, checking when did the journey of a multi-bagger start, it was typically post that sharp correction we had in COVID. More recently, if you see the journey of several multi-baggers which started, in the last couple of years, it was, from the bear market that the mid and small caps were undergoing, 18 months back. So the base condition that you need for a multi-bagger, for the multi-bagger journey to start is a deep, broad-based market correction. And once, typically we don't like corrections, but counterintuitively, corrections, when I say corrections, I mean a deep correction in this context, or a bear market, which means that multiple months of markets going nowhere, or a short burst of a very deep correction like what we saw in COVID, that makes the condition ripe for us to hunt for multi-baggers and to increase our probability manifold that whatever stocks we pick in that period can end up giving us multiple times of returns. So that is the first ingredient. The second ingredient is something I wrote about in my blog, long back, which turned out to be quite popular. The second ingredient of a multi-bagger is neglect. So you have to have a stock which nobody is talking about. So the neglect can be media neglect, which means that nobody is talking about it, or today in today's world, social media neglect. Nobody on Twitter is talking about that stock, or it could be financial neglect in the sense that the company is not doing anything for the last so many years. There's nothing has happened. Nobody's interested in that stock. So neglect in any form is another core ingredient that sets the conditions right for a multi-bagger to emerge. The third, again, is similar to neglect, but the idea of under ownership, right? Something that is not owned by institutions, something that is not owned by retail, is the third condition that typically you want to see when you're searching for multi-baggers. If you look at PSU banks, if you see this entire rally that is happening in PSU banks or in PSU stocks in general, the core variable or the core thesis is that these stocks, are severely underowned, which means that none of the mainstream portfolios, whether it is PMSs, whether it is mutual funds, owned these stocks, right? So PSU banks were hated. There were fund managers used to come on TV and say that we will buy anything but a PSU stock. So under ownership again is something that is very important for a stock to do well, because if a stock is over-owned or if a stock is owned by many institutions, then that means that most of the people who want to buy the stock already own it. So there are very few incremental buyers out there. So under ownership is one. These three kind of, you can bunch them together in one bucket, are related. Like I said, bear market, neglect, and under ownership. All of these three point to a similar, idea that so the stock is something which nobody is interested in. The stock is something which is, completely neglected. The stock is something which is completely undervalued, or the stock is something where nothing exciting is happening. Right. The next set of ingredients is something to do with new categories. So the other common theme that you will see in most multi-baggers is it will belong to a new category in the industry. So if you look at broking industry, right, we've always had brokers in the market. But what Zerodha did or what Angel did, they created a new category. So whenever there is a new category that emerges, there is this concept of value migration that happens. So within a given industry, when a new category is created, what exactly did Apple do when it introduced the iPod? Right, it basically created a new category in an existing ecosystem of the Sony Walkman and all of that, and it took away the market share for several years in a row. So creation of a new category is another ingredient that you will see in a lot of multi-baggers. Then the next one, of course, is new themes. So anything that is a new theme in the market will always something that the market does not have. For example, electric vehicles is a new theme that this theme has not been there in the market except for the last a few years, right? So solar stocks is a new theme. So this is a theme which has not played out in the Indian market. Like private banks is a theme which has already played out in the market. It's not a new theme. So whenever you have a new theme, again you have to become alert, that there is a potential for multi-bagger returns here. And a study of many multi-baggers actually tells you that low valuation, or in terms of the way we define valuation in terms of a PE ratio, is not a necessary condition for a multi-bagger. There are several multi-baggers which started with a PE which was much higher, but the earnings growth was so phenomenal that the initial PE actually did not matter. So just by looking at the PE ratio at the beginning, you cannot judge whether this stock has multi-bagger potential or not. A stock which has a 50 PE or a 100 PE at the beginning of the journey can also be a multi-bagger, and it is not necessary that just because the stock is trading at a 5 PE, it will have the potential to become a multi-bagger. So low valuation in the traditional sense is actually not an ingredient. So the key ingredients, just to recap this section, is bear markets, neglect, under ownership, new category within an existing industry, and new themes. So these are the core base conditions that you need. Once these base conditions are in place, you will need a catalyst for the re-rating to start. Or when I say re-rating, I mean for the market to recognize that something is happening here. So you will need the introduction of a catalyst. Just having a bear market or a deep correction is not enough. So that is just setting the groundwork. Then you will need a catalyst to enter the picture. And typically there are two or three different types of catalysts. One catalyst which I keep speaking about again and again is a multi-quarter, multi-year earnings expansion, right? So a stock that was not doing anything suddenly starts growing at a very fast rate. Is the catalyst that will be necessary for the stock to be bought by hordes of people over the next several quarters. So uh, a big earnings delivery is one of the main catalysts for most multi-baggers. So if you go back and study stocks like Aisha Motors, or if you go back and study stocks like Page Industries, or you name it, you will see that one of the, at least in these long multi-baggers. When I say long multi-baggers, I mean multi-baggers which spanned, multiple years, 3 to 4 years, the stocks continued to run. In most of those multi-baggers, you will see that it was a consistent earnings growth that the stock was demonstrating throughout that period, which led to them becoming multi-baggers. The second type of catalyst is when a game-changing change happens, which changes the earnings perception of that particular stocks. So the real earning may not be on the table in this case, but some reform or some government policy or some new product or some new management change, something enters the picture which completely changes the earnings perception of the stock. So for each of these examples, we can look at, a government policy change, like what's happening in the defense stocks, right? Defense stocks, have been listed for a while, but initial part, nobody cared about them. But once the market got this clarity that this government is really serious about, pushing the defense industry, both for import substitution as well as for exports, the defense stocks just were set on fire. Some of them were backed by earnings, but there are several defense stocks which have become multi-baggers without any earnings on the table. So it is the second category of stocks that I'm talking about, whereby without being the earnings on the table, just because the perception of the company has changed, the stock can end up becoming a multi-bagger. Right. Similarly, management change. The most cited example is CG Power. Again, if you see CG Power, if you just quickly see the CG genesis of that happened, in the bear market of 2020, right, when the stock was neglected, hated, there was corporate governance issue. All of those conditions were in place. Suddenly, a catalyst of management change enters, and a very reputed management takes over. And from there, the stock did not look back, and it gave us multi-bagging returns. So this is another example of when a game-changing something enters the picture which changes the perception of the earnings. And third, of course, are what I call as story stocks, right? Stocks which are pure play story, right? There is no earnings, and it's at least in defense and all that. Maybe the earnings are not there right now, but you can fairly make an assumption that earnings will probably come 2 years down the line, 3 years down the line. But you will see several multi-bagger stocks which are pure story stocks. Some story is floated on social media. The company also plays along. The stock becomes a multi-bagger, but underlying, it's important to recognize that it is neither a stock where earnings have been delivered, it is neither a stock where earnings will be delivered, but it is a pure story, momentum, speculative stock. So such stocks also become multi-baggers. When you're doing a study of multi-baggers, you have to do a holistic study. So you cannot leave something out just because it looks speculative. So there, most of the multi-baggers, in fact, I think will come in the story category. So, but once you recognize that such things can also happen in the market, which means that without any earnings, without any real thing on the table, the stocks can still become multi-baggers, right? So then there is a new opportunity set that opens for you. Whether you play it or not is a different question. How you play it is a completely different question. How do you manage the risk is another question. but that opportunity exists, right? So there are several stocks. I don't want to take any names here, but if you do your study, you will know, which ones are earnings backed, which ones are those where the earnings are not there now, but earnings will come in a few years. And then there are those stocks which are pure story where you know that the earnings, may never come, right? So these are the three main catalysts. So, so once the right conditions are there, once the right catalyst is there, next let us look at where typically do you find these multibaggers. So these multibaggers typically will be found, obviously in the mid and small cap space. It's very unlikely that in a large cap, a large cap becomes a multibagger, right? A large cap can become a small multibagger. It can go up 2x, 3x, 4x. But if we are looking at something to become 10x, 20x, 50x, then you have to look in the mid and small cap space. So that is one area where you will find. And the second area, based on whatever little study I have done, where you will find multibaggers is a low float relative to market cap. When the float is low, the market cap itself may be reasonably sizable, but when the float is low compared to the market cap, in that situation, what happens is it becomes so much more easier because see, if the float is less, then initially the float will be cornered by a few institutions or a few players, and if a flurry of good news continues after that, we again have a situation where there are many buyers but very few sellers, right? When there are very few sellers and many buyers, only one thing happens to the stock price. The stock price continues to go up. So low float relative to the market cap and mid and small caps is where we'll typically find multi-baggers, not always, but typically you will find multi-baggers there. And finally, how exactly does this whole thing play out, right? So typically you will see that once, the basic ingredient of a bear market, a deep correction, new category, new theme is in place, then you have a catalyst of, actual earnings growth or perceived earnings growth or a story entering the picture, then the stock basically goes into a mode where it starts exhibiting momentum, where it starts exhibiting relative strength. So a lot of these chartists and technical people actually enter at this stage, whereby they are looking for relative strength, they are looking for momentum, which is a kind of a shortcut way, because if you've not done the study or if you've not been tracking those stocks or the earnings, then some people try to find those stocks using these momentum or relative strength filters because a stock cannot do well. The stock cannot escape these filters, right? If a stock has to do well, if a stock has to become a multi-bagger, it has to show strong momentum, price momentum. It has to show very strong relative strength. So the things that you finally see when the stock starts to become a multi-bagger are very strong price action, very strong momentum, very strong relative strength. You will also see media coverage slowly and steadily increasing. Initially, it will be a few people. There'll be social media. Then it'll come in the mainstream magazines, and you know the works. And then obviously you will also see institutional ownership increasing. So if it is a genuine stock, if it's a genuine multi-bagger belonging to the first two categories that I spoke about, where there is an actual earnings growth and where there is a possibility of earnings coming in the next 2 to 3 years, you will also see institutional ownership increasing. You will see mutual funds buying those stocks, right? Because mutual funds will not buy a story stocks. Mutual fund will only buy stocks typically. Again, let's not generalize, but typically mutual funds will buy stocks which are backed by earnings or where the earnings delivery is likely in the future. So, and you will see the valuations expand, right? So when I say valuations expand, I mean that a 40 PE stock can become an 80 PE, 100 PE stock, or a 10, 15 PE stock can become a 60 PE stock. So throughout this journey of a multi-bagger, if you look at some of the examples I gave earlier of iShare, Page. So Page started off as a 18 times earnings, 20 times earnings stock when it IPO'd in the initial years. And finally, when the journey ended, it became a close to 90, 100 times PE ratio stock. So there will be a significant valuation expansion, and the stock will look expensive throughout the journey of its becoming a multi-bagger. So very quickly, a 15p, 20p stock will become a 40p stock or a 50p stock, and people will say it's expensive. But one of the key uh, signs of a multi-bagger is premium valuation, right? The valuation will remain high throughout the journey, when it becomes multi-bagger. Of course, once the story ends, the prices will fall, the valuations will compress, which is the other side of the story. We are not getting into that now, but we are discussing about how a multi-bagger comes about. And finally, you know, when you look at kind of exiting this, if I can, very briefly talk about it, it is, typically when the market cap, becomes quite high, when the market cap becomes into a zone, where, let's say, a market cap of anything more than, once it has hit a market cap of, let's say, 50,000 crores, right? Then from there, you cannot expect a lot of fireworks, right? 50, 60, 70,000 crores is, it's that zone where most of the, easy money would be out. And from there, some stocks end up becoming compounders, which do well. And some stocks, give back, all of their returns. So, and finally, very quickly on the portfolio construction, uh, multi-bagger, the journey of a multi-bagger is not a straight line. There are deep drawdowns, right? So any multi-bagger you pick up and you trace the journey over multiple years, you will see several corrections of 30, 40, 50, and sometimes even 60% in that journey. So if you are, trying to look for multi-baggers or ride a multi-bagger with a stop loss kind of an approach, it will never work for you because your stop loss will be hit because if you're planning to hold something to make 10x, 20x, 30x, 40x, then you have to sit through the 30, 40, 50%, 60% drawdowns. And the only way to sit through them is something that I learned the hard way, is to have a diversified portfolio, to have allocations where even if a particular stock or a set of stocks fall 30, 40, 50%, it does not hit your overall portfolio so badly, and you are able to sit through those pain. Because if you have 20% in a stock that you expect will become 10x, 20x, and the stock falls by 50, 60%, then that's very painful at times to sit through. It's very painful and it forces you to take the wrong decision at the wrong time. So the stop loss kind of an approach will never work for a multi-bagger journey. It has to be, an allocation-based risk management that one has to do. So with that, I think I'll kind of stop here, and Prince can maybe ask any questions based on what I've spoken.
So, Prabhakar, when you say small cap, the SME space is also included in that, or is there any? I mean, you told about the upper side of the market cap from maybe become more of a compounder. On the lower side, also, is there some market cap in the back testing you have done, or any sense around that, sir?
No, lower side, there is no, see, the lower the better, right? Because mathematically speaking, we are looking at a multi-bagger, right? So the smaller the market cap, the better. But the flip side of that is the smaller the market cap, the more risky the whole thing becomes, right? So if you are into SMEs or micro caps and those kind of things, then your due diligence has to be that much better. Your allocation has to be that much lower or adjusted for the risk that you are taking, right? So mathematically, the lower the better. But from a risk management point of view, I would say a sweet spot, because see, if it's a very small market cap, then institutions will not be interested in such stocks. The biggest multi-baggers happen on the back of institutional ownership. The biggest multi-baggers happen when you found something which the tomorrow's mutual funds and institutions and FIAs want to buy, right? So in that sense, I would say, the maybe the lower end will start from anywhere between two and a half, 3,000 crores, to 5,000 crores, and you can hope that you buy at that level, and then the stock becomes a multi-bagger. The lower you go, the more smarter, the more efficient, the more effective you have to be in understanding that you're not buying something which is, for the lack of a better word, operated, or something that is very risky.
When it comes to exiting, so what should be the framework? As you also said that no, it's obvious there would be multiple drawdowns within the journey, but at which point in time one should book and come out, and at which point in time one should continue? How to make a decision on that, Prince?
No, I think there are two or three levers there, right? So one lever, like I said, is the market cap. So when the market cap becomes, reasonably high, when something becomes, a large mid cap or a large cap, then at least the stock can continue to do well. But from a multi-bagging point of view, I think the story becomes over once it crosses a certain threshold market cap of, like I said, 50 to 75,000 crores, right? Second is itself the top line. When the top line has grown to a number which is when you look at the industry size, is a fair percentage of that industry size, or a large percentage of that industry size, then I think you know that the story is about to get over from a multi-bagging point of view. And finally, the third lever is the margin, right? When the margins become unsustainably high, typically that is also a very good, indicator that things cannot continue forever once the margins reach those levels. Yeah, I think you are breaking up a bit, but if I got it right, you're looking at what is the right allocation, considering all the factors. See, I personally have, I feel a sweet spot is anywhere between, for a mid and small cap portfolio is 30 to 40 stock portfolio. So an allocation of anywhere between 2.5 to 3.5%, 4%. Because, even if a stock falls by 50%, at the portfolio level, you are losing 1.5%, which is manageable. So as long as you are operating with a framework that has an edge, right? Because end of the day, it's all mathematics. So if you're operating with a strategy that has an edge, and in the worst case, you're losing 50%, and in the best case, you're making, let's say on an average 3 to 4x. I think you will do fairly well, and spreading it out between anywhere between 30 to 40 names ensures that you open yourself up to enough optionality that like I said, the base condition is that your strategy cannot be random. Your strategy needs to have an edge, and with that edge, if you spread it out and create a basket of 30, 40 stocks, with the risk reward, like I said, when you lose, you may lose anywhere between 30 to 50%, but when you make anywhere between 100 to 400, 500%. I think for this kind of a structure, a 30, 40 stock portfolio with a 2.5 to 3.5%, 4% allocation works just fine. Yeah, so in that case, I typically do not tinker much. If something has done well, then I allow it to continue to do well, because that's the whole idea, right? So, of course, you can always take some bits off the table, to de-risk, or something to that extent, but nothing major. Like, so, let's say you bought something with the initial allocation of 3%, and you made a five bagger on it, so that became 15% of your portfolio. In that journey from 3 to 15%, I might probably, shave maybe one third of that, or, maybe less than that, one fourth of that, and still allow that position to be 10, 12, percent of the portfolio. If the position has become even more large, then let's say the 3%, it became a 10 bagger, so 3% became 30% of your portfolio. In that case, you would probably, instead of shaving off one fourth throughout that journey, one fourth or one third, you may still shave off a little bit more. But generally, it pays to let your winners run. It's difficult to do psychologically, and most of us, ideally, the best case would be that we don't disturb it at all. But just to get that little bit of psychological relief, there is nothing wrong in taking something off the table throughout the journey whenever the stock becomes extended. Uh, but the but the majority of it has to be left alone for us to really take the portfolio to the next orbit.
Understood. And just one last small question. How do you exit? When do you exit?
Yeah, I spoke about that in the last response, right? So three parameters I said. One is, you look at the market cap. When the market cap becomes reasonably large, it becomes a large mid cap or a large cap category kind of a stock, you look for signs of exiting, or when the revenue is, becomes significantly large, right? So multi-baggers, when the journey starts, the revenue will be sub 100 crore, 100 crores, 200 crores, 500 crores. And once that number goes to, let's say $1 billion in revenue or some such, very mainstream type of a number, then you know that, the story from a multi-bagging point of view is over. And finally, the margin. When the margins became unsustainably high, when you know that the operating leverage is at its peak, that is one more sign to look for selling.
Excellent. Thank you so much.
Thank you, JC. So next in line is Ron. Ron, you can unmute and go ahead, please.
Hey, thanks, Prince, and thank you, Prabhakar, for an amazing framework. Really appreciate. Just wanting to understand, I think you spoke wonderfully about the first 5 points that one should look at in identifying where to find the multi-baggers. Uh, if you can elaborate more on you spoke about the X factor in the catalysts, right? Where it can be, whether everything changes. And you gave the example of defense and where Government of India kind of clearly laid out the path for defense. I mean, any other examples if you can share, like how do you identify this X factor? Uh,
Yeah, I mean, I also gave the example of CG Power, right? Which, there was a management change, right? Which again was an X factor. It was quite obvious also at that point in time, right? So what has been happening in the power sector is also a great example. There is an industry, there's a countrywide power shortage. Not only in India, there's a power shortage, but globally also, there's anticipated to be a power shortage because of, the technology and the AI and all of that. So, so these are some of the examples, right? I mean, if I put my mind to it, I can probably think of some more, but essentially it is, it is, like I said, whenever a new uh, theme or a new category comes into play, that is where we have to start paying attention, because generally you will find these catalysts playing out there, right? So that is what I would say.
Sure, sure. Thanks. Just one last question. You wonderfully summarized where do you find these multi-baggers, right? You said first point is small and mid cap, and the
Correct.
second point being low float.
Yes.
Now, I think Vijay Kedia ji also mentions the second point that you highlighted here, where he mentions
Yes.
that a low float allows him not to look at the volatility, doesn't allow him to exit the stock, and that allows him to be a long-term investor. So,
Correct.
completely echoing that point. Just, and this is a personal question I'm trying to understand because I do have a tendency to kind of look towards the small and mid cap because that's a no brainer where multi baggers kind of come in. Where do you draw the line from a portfolio allocation point of view? Like couple of years ago, I was having a portfolio allocation, let's say of around 50% large cap and the rest being small and mid cap. But with passage of time, given your multi baggers also, if you let them run, it becomes a bigger chunk of your portfolio. So, what are your thoughts in terms of your portfolio allocation from a large and a mid and small cap allocation perspective?
No, it is a see. It is a very, like you said, it's a very personal. It's a very personal choice, right? See, if you are in the game to make money, right? Then of course you will have to have those or like if you're managing public money, then you have to have an asset allocation in place to manage the risk reward equation, to manage the volatility, right? So it really depends on what the goal is. At the personal portfolio level, again, see, I personally enjoy being in mid and small cap space, right? So even if it means that the volatility is more, I know that the alpha also is more structurally in the mid and small cap space. So when I construct a portfolio, if I were to construct a portfolio for for myself, then I would only be in mid and small cap space. And like I said, I would mitigate that risk by diversifying into more number of stocks, right? So the what is the risk in mid and small cap space in a diversified portfolio? The only risk in a diversified portfolio in a mid and small cap space is market risk, right? The risk that when a correction comes, a large cap portfolio would have fallen 10%, you would probably fall 20-25%, right? So if you're willing to live with that kind of a drawdown in exchange for enjoying the returns on the upside, because when you look at it across the entire cycle, right, what typically happens is a large cap portfolio might go up by 50% and post the correction come down and settle at 25%. The mid cap and small cap portfolio will go up by 100% and come down and let's say settle at 40%. Okay. Still, over the cycle, you have made more money in the mid and small cap. So that is how I look at it. But the price for that is the higher drawdown, the higher volatility. But across a full cycle, if you play it well, then there is more money to be made in mid and small caps, which is why I feel if somebody is up for it, then they should have their entire portfolio here because that is where more money is. But if you have other considerations like risk profiling, if you have other considerations like volatility, I don't want, then of course you can have a component of large caps also in the portfolio.
Sure, sure. Thank you and appreciate the framework. It was really great. Thank you so much.
Thank you.
Thanks, Ron. So, before coming to Vandit, so Nafas has one question, sir. He's asking, you didn't mention anything about cyclical or secular stocks. Can deep cyclical stocks become multi-bagger stock as per this framework?
Yes, yes. I did not specifically spell out cyclicals, but when I spoke about the emerging from a deep correction, when I spoke about the idea of neglect, right? So the first thing that actually comes on the radar is cyclical stocks, right? Because cyclical stocks, when the things get really bad, they are beaten down and they are completely neglected. Nobody wants to own them. And on top of that, if you have a deep correction or a bear market, then the valuations get compressed even more. So cyclical stocks are in fact some of the if you take out a list of multi-baggers in any given year, a fair chunk of that will be actually cyclical stocks. Like many experienced people in the market say that eventually all stocks are cyclical, right? All stocks are price cyclical, may not be business cyclical, but all stocks are price cyclical. But I understand from where you are coming, cyclical stocks like metals, commodities or chemicals and these kind of things. If you buy them when the margins are, completely compressed, beaten down, neglected, and a proper catalyst enters the picture whereby the industry dynamics changes for whatever reason, you can make many multi-baggers in cyclicals, and that is exactly what value investors do. Value investors exactly do this. They look for beaten down, neglected stocks. Sometimes they enter before the catalyst, which is also okay. But in my framework, I would rather enter after the catalyst and try to time it a little bit more, at least attempt to time it.
Right. So, thank you. So, next is Vandit. Vandit, you can quickly unmute and ask your question, please.
Hello. Uh, I want to ask that a similar kind of framework I follow where I choose stocks which have like good 30-40% sales and profit record and are available at decent valuations and are not at their peak margins. But sometimes what happens that even when I find a stock 5-6 days after or 10 days or even a month after, I found a even better opportunity. So what to do? How to resist the temptation to go and buy that stock, or how do you handle this kind of situation?
See, if you are not sure which stock will do better, whether stock A will do better or stock B will do better, then you have to buy them both. That is where again the idea I spoke about why we should have a diversified portfolio is because it gives us the optionality, or it introduces a luck factor in the portfolio. And a lot of times in the stock markets, you need, for luck to favor you, you need to open yourselves to, luck. So one of the ways of opening yourselves to luck is to have a fairly diversified portfolio, whereby you don't know whether stock A will do well or stock B will do well. So you buy a bit of both, and even if one of them works, and especially in the mid and small cap space, because the winners in the mid and small cap space are very high in number. So when you win big. So even one such winner can completely transform the returns of the overall portfolio. So I would say when you are in such a doubt, both of them look good, buy them both. Over a long term, you will realize that that is the best way, because there is really no way to choose, without the benefit of hindsight, which one is actually better. I'm assuming both of them, are similar, and you're not able to decide. And in that case, you have to buy them both. You have to make space for both of them in the portfolio.
Okay, understood, sir. Thank you.
Thank you, Vandit. So, Prabhakar, something similar which Jitendra sir has asked. So, basically, when it comes to 30, 40 stocks, so how come, like, when it comes to rebalancing, say, if there would be n number of multi-baggers within those 30, 40, so you'll be rebalancing all those I mean, stocks which are doing good, and or it would be like you'll keep on riding those, and the allocation would again be like disproportionate in the sense it won't be like 2-3% as you were suggesting for all the stocks. I mean, how exactly you go about churning, or maybe a suggestion on that front?
No, no. See, there is no rebalancing required if the stock is doing well. So, like last year in our own portfolios, right, we did 100% return. So, I did an analysis of how did we get this 100% return, right? So I had this, portfolio of 35 stocks. So, like you said, this portfolio also had several multi-baggers. A lot of them were up 3x, 4x, 5x, right? And if I had done any tinkering with the winners, right, beyond a point, like I said, some tinkering we have to do because of psychological reasons. So some profit booking, is something we have to do, and we have to allow for that. But any major tinkering, if I would have done, then let's say a stock that became a 5x in my portfolio, if after it becoming 2x or 3x, I did some major rebalancing exercise, then the portfolio return would not have been that high. So there is no optimal formula, for this. So the only way is to allow your winners to run. Once in a while, you are allowed to take some profits, book some, reduce some allocation, but nothing, meaningful. And the churn is always on the stocks which are not working, right? So you bought something because you felt there was a catalyst, right? And after 1 or 2 quarters, you realize that, boss, this is not playing out how I thought it will play out, or it should play out. And that is where the churn comes in. You don't churn in the winners, you churn in the losers, and try to replace the losers with new potential winners.
Full point, sir. So next is Sibi. Sibi, you can quickly unmute and ask the question, please.
Hi, Prabhakar. This is Sibi Chakravarti. Thank you for your generous time in teaching us, and thank you for your intent for teaching your knowledge. So my first question is, it's kind of related to the previous answer you gave. So let's say you have certain allocation for equity and you have maxed your allocation, and right now after this you see 10 more opportunities coming in. So what would be your next step? So these 10 opportunities also, according to your criteria, they deserve to be in your portfolio. So would you be trimming some of your existing holdings to allocate more capital to these new opportunities, or would you try to play a elimination game and eliminate some opportunities and stick to your most conviction opportunities? Yeah, that's my question.
Yeah, see, at some point you have to draw a line. So if something new is coming up, then you have to kind of judge whether, how big is this opportunity? What is the upside? See, at some level, whenever a new opportunity comes, and before you size it in your portfolio, you have to develop a sense of how much can I lose on this if I go wrong, and how much can I make on this if I go right. So you have to make it a little bit mathematical, a little bit data based, because otherwise the mind will not allow you to take clear decisions. So even if it is not perfect, even if your numbers are not perfect, with experience, you will get better, but you have to have some sense that, okay, a new opportunity is here in front of me. I feel that if I get it wrong, maybe I'll lose 25% on this particular stock. And if I get it right, maybe I'll make 100% on this particular stock, right? So when you have that number, ahead of you, and then you compare that with the rest of the 10 stocks in your portfolio, in your example, I think you will have a very clear answer. If you are not, if you feel that what you have and what is new is similar in terms of risk and reward, then I think more often than not it pays to stay with your existing names which are already there.
Thanks for the answer, Prabhakar. That was a really great answer. My second question is, so you had previously answered how to exit favorable winners, which is based on size and reaching a maximum margins. So how would you exit unfavorable ones, whereas a pick goes wrong or it's not performing as expected? Uh, how would you exit? Is it only a fundamental deterioration based exit, or do you have price based stop losses or something like that? Because you had mentioned that you have to endure 50% or 40% drawdowns. So I was curious. Yeah.
Yeah, it cannot be price based. It has to be fundamental and judgment based, because, like I said, if you want to make 10x, 20x, then you cannot have a stop loss business, right? A stop loss business comes into play when you're doing trading, right? When you're swing trading, when you're playing for a 15-20% bounce, and you have a 5% stop loss, right? So you have a 1:4 risk reward. So when you are playing for a 10x, you have to be okay with a 50% drawdown, right? So there is no really no way to avoid that. So your question, if you can just repeat what exactly it was.
Uh, so when you exit unfavorable stocks, for example, they are not performing as you had expected. So you had answered now that you would be looking for fundamental
It's
based
fundamental. It's
exit, not
fundamental. Yeah. To answer your question, it is fundamental based only. It cannot be stop loss or price level based, especially when we are talking about multi-baggers. It has to be a fundamental judgment, and I think market also makes it quite clear, right? I mean, doing it on the basis of price takes some experience. Something like the relative strength of those stocks will deteriorate, right? Let's say something is not working out. You bought something, and one of the signs that it is not working out is if the relative strength is deteriorating, right? If the rest of the market is in a very bullish phase and your stock is not performing well, then it means that either your timing is off or your judgment is off, right? So if you are confident about your judgment, so it's an interplay of, like I said, judgment and timings, right? If your judgment is off, then that is an introspection that you have to do, depending on your experience and number of bets you've taken and all of that. But if your timing is off and you're confident that your judgment is right, then you have to give it a couple of quarters more. You have to have some sort of a timeline that, okay, I will give it this much time, because end of the day, money has an opportunity cost, right? So you cannot hold something forever. Especially people like us who manage public money, right? It's very difficult to hold something that is not performing at all, because we have to beat the markets. If the entire market is going up and my portfolio is not going up, that can happen for 6 months, 1 year, but after that people will lose patience. And the same holds true for your personal portfolios also, because at the end of the day, it's an opportunity cost, right? So yeah, so that's how I would answer it.
Thank you so much, Prabhakar. You've answered all my questions. Thank you.
Thank you, Sibi. So next in line is Subramanyam. So you can unmute and ask your question, please. Mr. Subramanyam, you can unmute and ask your question.
Yeah. Hi, I'm audible.
Yeah, yeah.
Yeah, please go ahead.
Yeah. Hi, Prabhakar, thanks for this framework. But there are views instead where you were mentioning that you should have a basket of 30 to 40 stocks for
Yes,
diversification. But
correct.
there's other view, if you are diversifying anything at about 25 stocks, then the impact of say what you make as a multi-bagger doesn't really, and your position sizing also will then get impacted. So how do you balance between that?
No, no. See, all those are theoretical things, right? It's an idealistic scenarios, right? If I know 100% sure that a stock is going to be a multi-bagger, I will put 100% of my portfolio into it, right? The whole point is we have to step back and look at this entire game. So what is the game? It is a probability game, right? Even the promoter of the company doesn't know how the company will be 5 years down the line, right? So who are we to? So end of the day, we are all taking a probabilistic bet. So how do you play a probability game? So some people might hold a very concentrated portfolio and may succeed, right? But that doesn't make it a, that is a, matter of their expertise, or maybe it's a matter of, I won't, let me not call it luck. Okay, let me call it that some people are genius. So some people have that capability that I know for sure that these stocks are going to be multi-baggers. So I will own only 5 stocks, or I will own only 10 stocks. So if somebody belongs to that category, well and good. But when you're speaking to a general audience, right, and when you're speaking to somebody who is average, somebody like me who is an average investor, I would think, when I'm playing a probability game, I have to find some number where even if I get something wrong, it doesn't kill me, right? It doesn't kill my portfolio, it doesn't kill my returns. Of course, if I get it right, I will make a little bit less in a diversified construct. But the fact is that I don't know when I'm investing whether I will get it right or whether I will get it wrong, and how much I will get it right and how much I will get it wrong, right? So that is why you come to a sweet spot, right? So I said 30 to 40 is a sweet spot for me. Somebody may say, no, not 30 to 40, maybe 20 to 30. Somebody may say, but yeah, obviously you cannot have 100 stocks, right? When you go to 100 stocks, what you're saying becomes valid, right? That if you take the idea to the extreme, then yes, if you're buying, something 0.5% of your portfolio or 0.75% of the portfolio, then even if you make a 10 bagger, then you hardly move the needle. But I think we have to, in the other extreme is buying 5 or 10 stocks. So that is why I said let's stay somewhere in the middle where we bet enough that even if we go wrong, we survive, and even if we go right, then we make meaningfully large. May not be as large as a very concentrated investor, but that is the price we are paying for not knowing upfront, what exactly will happen to the stocks that we own.
But again, Prabhakar, say with the same skill set, like keeping 15 stocks and say for that matter 30 stocks. So do you think like on the risk side, do we move towards a very high risk thing because like 2.5% allocation and 5% allocation on the portfolio level? So do you think that will materially change, or it's like obviously individual risk appetite? I mean, if you can throw some light around that.
No, see, it again, 2.5 and 5, it is debatable, and that's not a debate that we should probably get into. But the point being, I told 2 points, right? The people missed the second point. The first point, of course, is risk management. So if you own 15 stocks in 2.5 versus 5%, then essentially you are doubling your risk, right? So if for whatever reason there is a a bad market, or you get all your a lot of your bets wrong, then you will be hit more, and you will have to you will need so much more time to recover back what you lost, right? The second factor I spoke about is optionality, right? When you buy 15 stocks, right, and versus when you buy, let's say, 30 stocks, you are getting 15 more stocks in your portfolio which can become multi-baggers. So the whole idea here is that this concept works only when you're dealing in mid and small cap stocks. If you're working in stocks like Hindustan Lever and Asian Paint, then you're better off with 15 stocks because they're predictable in nature relatively. But when you're working in a mid and small cap universe, a micro cap universe, or whatever, the additional 15 stocks that you're buying is also giving you an optionality that even if one or two of them work, then they can transform your portfolio. So, so it is both risk management as well as optionality. which both have to be considered. So with 15 stocks, you are again being very sure that these 15 are the best ones. So I'm saying give yourself some space, allow luck to play out in your favor. So create, I mean, give some space. That's my idea. I mean, people need not follow it, but that's my idea that you are getting both risk management and optionality. And in most of the cases, I'll tell you, the 15 stocks which you don't buy, right, they will end up doing well, right? In my own portfolio, the stocks which have performed the best in the last 1 or 2 years, they were not the stocks which I envisaged will do the best, right? Because by definition, stock picking is a game of future, and there are multiple variables. So you have to open yourself up to a fair surface area of luck, which is why I said I feel that 30 to 40 is a sweet spot. But after that, it's a debate that I think one should not get into too much. It's a personal preference.
Fair point, sir. So, Anil Maharaj, you can unmute and ask your question, please. Mr. Anil, I think is not available. So, Rahul, you can unmute and ask your question, please. CA Rahul. I think he's also. So, Gaurav, you can go ahead, please.
Thanks, Prince, and thanks, Prabhakar, for sharing your insights. Uh, I've been following you and have learned a lot from you. Uh, so, I think my question is: I think you talked about diversification strategy with 30 stocks, but I once saw your tweet regarding on the cash calls, that even if you keep a 15% cash, it doesn't impact your returns much mathematically. So,
Right.
right. So can you talk more about that? That like suppose you are seeing an overvalued small cap index overvalued stock. So you don't go for a cash call at all because that's also kind of market timing. Just like you are waiting for a bear market to invest in higher amount.
Yeah, see, you take a cash call, like I explained in my tweet, right? See, you're taking a 20% cash call and getting a 20% correction right just gives you a 1 or 2% portfolio level benefit, right? So the question to ask is, can I predict a 50% fall, right? So if you can predict a 50% fall, then it definitely makes sense to go 20, 30%, 40% in cash. Okay, that is one way to look at it. So, but I feel that in a bullish phase, you will see that corrections of 10 to 15% on the index are very normal. So if you study the bullish phase from 2003 to 2007, or if you see from 2011 to 2000, 2013 to 2017, or if you see the one now, from 2021 to now, the post COVID, you will see there are several corrections of 10, 15, 20% on the index. But but the 50%, this 10, 15% correction, we've already proven that you can't do much, right? Even if you go a little bit into cash, it doesn't matter much. So the big corrections which comes once in several years, right? 50%, 60% corrections. Those corrections by definition are unpredictable. And if you start, assuming that every 15% correction will become a 50% correction, then that in that in and out, right, you will get chopped so many times that even when the actual correction arrives, you exit and come into cash. Whatever you have lost here, right, that will still be more than what you will save when the actual correction comes, because the actual correction comes very rarely, right? So that is one point, that you have to really think about. And secondly, this idea of going a lot into cash. Right? Let's say you want to go into 50, 60% cash, right? There is this book, Masterclass by Super Investors or something, right? So there is I think it was Hiren Ved, right? And the famous fund manager of Alchemy. You read his story, right? 2008, they went into cash before the crash. Okay, significantly into cash they went into. And when the markets turned, right, you are psychologically you will not enter back. They did not enter back when the markets turned, and the rallies that come after a 50% crash are so ferocious that you will just be sitting on your hands with all your cash. The market will not allow you to do anything. It's only theoretical exercise that you think now that I will sell here and when the market bottoms, I will buy, right? Because when the market is falling, you will keep waiting, wanting the market to fall more, or expecting the market to fall more. And when the rally comes, it will be so ferocious. Bear market rallies are so ferocious that you will not know when to enter back. So it's not so easy, right? The whole cash game, it's not easy even for a small correction, even for a big correction to get both the sides of the equation right. So I encourage you to read that story of how they were in cash and their clients were all going gaga, and then when the recovery came, they were completely underperforming, and everybody started shouting at them. So the whole cash call business is something I've learned. It's better to take the drawdown, you know, than get into this cash call business because net very very rarely, once it may work in your favor, twice it may work in your favor, but across an investing lifetime, the odds are against us that we'll be able to time the sell and the buyback at the right time every time.
Thanks, Prabhakar. That was helpful. Thanks a lot.
Thanks, Gaurav. So next is Gorang. So Gorang, you can quickly unmute and
Hello, am I audible, Prabhakar?
Yeah, go ahead.
Yeah. So I want to know your journey from a single stock owner, super concentrated, to a fairly well diversified portfolio, which is based on a catalyst. So how you evolve that, and how you change your strategy, and what's your learning?
Yeah, so I think this space is turning out more about the concentrated and diversified portfolio than multi-baggers. But that is where I think the interest of most people is. But yeah, so when I was a concentrated investor, I would say I was very naive. I was kind of foolish also to some extent to believe that like I said, see there are two aspects of a diversified portfolio. Like I've spoken multiple times in this space. One aspect is risk management, right? Whereby just by owning 5 stocks or 10 stocks, right, you feel that when you're young, you feel that you're very smart, and but the markets have taught very very strong lessons to the best of us, right? A lot of experienced people out there, and everybody will tell you that you know. Being concentrated in and I'm being very clear here, right? So if you're operating in a large cap space, then you can be concentrated because the business and it's more predictable, right? So Warren Buffett being concentrated because Warren Buffett is not meddling in mid and small cap stock. Please understand that before quoting Warren Buffett and all of that, which people do. Warren Buffett is buying the apples and the cokes of the world, right? So he can afford to be concentrated. Plus, there are other nuances like he has a lot of float and a lot of cash and all of that. So when you are operating in a treacherous zone like mid and small cap stocks, you have to be diversified because your odds of going wrong are very high. So you cannot own a 5 stock mid cap portfolio or 10 stock mid cap portfolio. Although in a bull market it will really work, and all of us will look like fools. But eventually, we have seen enough cycles turn, right? Eventually, when the cycle turns, you will, you'll have to go through immense pain, of seeing everything evaporating right in front of your eyes, right? So, risk management is definitely one angle. And second angle, like I've been speaking about, is optionality. I have learned that I used to own Hawkins, Page, these 2 3 stocks, and when I studied back and I realized that I missed out an Symphony, I missed out an Avanti Feed, I missed out an Astral Poly. All of these stocks I had seen, but in my craze to be concentrated, I still did well with Page and Hawkins and all of that, but I missed out so many other stocks which went on to become bigger multi-baggers, right? So if only I had created space for these companies in my portfolio, I would have been so much better off, right? So optionality is again a concept which many people don't appreciate or understand, and the market has also taught me that. Like I gave the example, right? Last year we did phenomenally well. We did 100%. So when I went back and studied my portfolio, I realized that the best performing stocks in my portfolio, right, out of the 10 stocks which have done phenomenally well, I would say, three or four of them were something which I predicted will do well, but five or six of them were a surprise to me also, right? Because how the entire thing played out, I would not have been able to judge at the beginning of the journey. How will the quarterly numbers be? How will the external environment change? How will the market re-rate them? What will be the new narrative that will come up? So all of these things are something which happen in the future. And future by definition is unpredictable. And when you're dealing with something unpredictable, it's better you spread out your bets. So, so concentration was a very arrogant and naive thought that I had. And now, having spent so many years in the market, I've realized that it pays to be humble, and not only it pays, in the sense of risk management. Like I said, the market can surprise you, in phenomenal ways if you allow the market to surprise you, and that is what a diversified portfolio helps me to do. And within that, like I've said, there is a sweet spot, right? Some people will have 80, 100 stocks also and still do well, right? The best performing small cap mutual fund, if you go and see, is I think one of the best performing now, if not the best, is Nippon Small Cap. Nippon Small Cap has a AUM of I think 25,000 crores or more. Number of stocks in the portfolio is 256 or something, right? 200 plus stocks. And the guy has done 40-50% last year, right? So last year, of course, was a bull market and all of that, but I'm just saying, right? So it is not that diversified portfolios can give phenomenal returns. When you adjust for the risk, I think diversified portfolios are phenomenally better than concentrated portfolios. That was my insight, that adjusting for the risk, right? Concentrated portfolios are high risk, high reward. Diversified portfolios are low risk, high reward. So when that light bulb went off, I think that is when I changed my strategy.
Amazing clarity of thoughts, Prabhakar. Thanks.
Thank you,
Thanks.
Gaurav.
So, Babuji, you are next. You can unmute and speak.
Hello, Mr. Prabhakar. Good evening to you.
Good evening.
So, this after pandemic, the number
Yeah.
of multi-baggers are too many,
Yes.
and many people have benefited despite
Yes.
doing wrong or right.
Yes.
Now, in future, the methods are known to many, may not be to all, and data is much more available or much more analyzed in last 3 years than previous.
Okay.
Uh, Based on not a political thing, but if the present reforms continue, irrespective of government, will similar opportunities again crop up for getting mix of multi-bagger and good performance? It is impossible to think that you get only multi-baggers. I would always yearn for some few multi-baggers and remaining good performers.
Yeah, see, good performance you will get in any decent market environment. But if you were there when I started off the talk, I spoke about a few ingredients for a multi-bagger, right? And what are the ingredients for a multi-bagger? I gave you a few. The main ones being a deep correction or a bear market. That is one of the primary conditions for the start of a multi-bagging journey, right? Because a deep correction or a bear market is what allows the valuation to be so compressed, the neglect to be very high, for all the weak players to be out, and very little supply to be there, right? And then I spoke about the idea of a new category in an industry or a new theme in the market, right? So now all of those things have already played out. Now for the next set of multi-baggers to emerge, the clock has to reset. So we need to have another deep correction. We need to have another bear market, right? We need to have new themes come up, right? Because these are structural things, right? A bear market, like I said, compresses valuations, increases neglect, new theme and new categories, right? And people don't believe in, right? There's under ownership. People don't believe in them. So all of these things coming together create a multi-bagger. So where we are now, if you ask me, all of these things have already played out, like you correctly said, right? So many multi-baggers have already come about. So now from here, multi-baggers is not going to be easy. It's not going to be so rampant like how we saw post-COVID or in the last 1.5 years. So from here, it's going to be more of good performance. The next clock will reset when we have another deep correction or a sharp correction or a big bear market. That will again create the environment for a new set of multi-baggers.
Yeah, but that time your own portfolio also would go down.
Yeah, so that is immaterial to the market. No, I am talking
Yeah,
about. So you may have to put new cash. You may have to switch from some other stocks to these new set of stocks. So market
yeah,
is not bothered about our portfolios. The market will do its thing. That is what I'm saying. So
yeah. I
now,
agreed.
so
Uh,
so so we have to wait. So if you want another set of what you have to do is psychologically prepare yourself. When you understand this, then on some level you look forward to bear markets because you know that on the other side of bear markets, on the other side of deep corrections are multi-baggers. So it is the psychological preparation that is the key, right? So with this knowledge, when the next bear market comes, you know that something good is likely to happen because the conditions are right now. Nobody likes stocks. Nobody wants to own anything. If I put some money to work now, I can multiply it multiple times. What has happened to your existing portfolio is history, right? The market doesn't care about it from a multi-bagger point of view.
yeah,
Yeah,
thanks. Good insight. But
thank you.
I have one more thing to ask. I'm talking about bold reforms if a new government or the present government starts. Most likely, people are thinking the present
No,
government will be able to make bold reforms which they are already talking about. So such bold reforms can create a new multi-baggers even in the a fairly good market. I would not say a bear market, but fairly steady market or sideways market.
it can create if there is a new theme or a new category that comes about, definitely. But if it is the existing things like defense and solar and all that, then those stories have already played out.
Yeah.
So
So
so if there is a new reform, if there is a reform that comes about in a new category or a new industry or something which the market doesn't own, or a new theme comes about, then that will be a specific area to look for a multi-bagger. Yes, I agree, but not in the continuation of the current set of reforms,
yeah,
because that
yeah,
story has played out in the sense
yeah.
that
Already that.
the
Yeah, that
market
is.
knows. Yeah, so market has priced in the next 2 years. Why do you think these stocks have done so well? The market is a forward-looking mechanism, no? It has already discounted the next 2 years already.
Yeah,
And that is why if the current government does not come, the market will crash. Stocks will fall to, anywhere between 30 to 50% because the
yeah,
market is already pricing in the next 2 years.
yeah. I agree with you.
Thank you.
Thanks. Thanks for your insight.
Thanks, Babulalji. So Nadeem and then Vijay.
Prince will take a one or two last questions, please.
They are last two speakers, Prabhakar. Yeah. So Nadeem, you go first and then Vijay.
Sir, I have only one question regarding geofinance. Can it be a potential multi-bagger?
Yeah, Nadeem, sorry for that. Individual stock specific queries will not be answered. I hope you understand. So Vijay, over to you. You can unmute and ask a question.
Yeah, audible?
Yeah, yeah, go ahead, please.
Okay. Actually, I wish to ask which question Babulaji asked. Thanks for the revert. And my
Okay.
addition to that query, mean I am new to this market in small cap. So my query is that in that scenario, after 4th June, new government will are going to be formed. So in that case, what we should do? We should keep cash in our hand, or whatever our portfolio is doing, we should go ahead with this.
See,
So Prabhakar, I mean, you can club this question along with like the current market outlook, how you are seeing it, and the possible scenarios within the election time. Maybe the same government coming again, the majority is not as the numbers are expected, and the worst case scenario is the government changes. So that would be helpful, I guess.
No, I think all of us know the scenarios. I think it is being played out, innumerable times on Twitter. What happens if they win 300, if they win 272, if they win 400. So I don't think there is any value I can add to, that discussion, right? So I am focused on, picking stocks. I'm sure that, see, if you study the history, right, two instances I'll tell you. I went back and it doesn't. I mean, future doesn't repeat, right? For sure. But just for fun, I did this exercise. So post the Modi first government came, right? There was a very similar euphoria pre-election, the first term, right? And markets went up sharply. And post the election, there was a euphoria for 6 months, and then the market went sideways for 3 years or 2 years at least, right? So that is one scenario that can happen, right? Unless like somebody said, some very new big bang reform comes, right? If there is a continuation of this kind of a thing, what is already happening, then we may, and this government comes with a good majority. I think we will see some euphoria post the election, and then there will be sideways consolidation. That was one of the things which happened. The second scenario was when the India shining, right? When the Atal Bihari Vajpayee government fell, right? Surprise, it was a surprise to the markets, and UPA won. Right? If you go and see a similar rally pre-election happened even then, and post the election when the BJP government fell, the markets crashed. I think 25-30%, and the UPA government was formed, which was again a majority government. So the market then took off on its biggest, bull run, the 2004 to 2007 bull run, right? So I think it's fair to say that although from a market point of view, if you take out all emotions and political biases and everything, I while I would want to point out that I personally feel that this government has done a phenomenal job, which has never been done before in terms of the reforms. But if you remove out everything and see it, strictly from a neutral point of view, what the market wants is a stable government, right? All said and done, that is the first criteria. So if a stable government comes, irrespective of whether it is one party or the other, I think the market will be okay. Of course, there will be knee jerks and all of that. But if a Khichdi government comes, right, and that is where the real problem starts, right? If the Khichdi government comes, and if the populist agendas, those are the things historically the markets don't like. So actually, the people at the center, we have seen, if you see the history of the Indian stock market, it's more to do with, either you let the market be, like let the capitalists do their job, don't meddle in their affairs, and you do your own thing, the market will be okay, right? Or like what this government has done is proactively introduce reforms, the market will do well. What the market hates is uncertainty with respect to policy making and populism, right? So these are the two things which we have to be wary about, irrespective of who comes. And I sincerely hope that this reform momentum continues. That is my hope, and that's a personal opinion, but yeah, that is what it is.
So, Prabhakar, although we are short on time, so totally your call if you want to take. So, earnings season has been ongoing. So, any sense around like how it had been across these sectors, and any one or two sectors wherein you think the earnings have been pretty good? I mean,
I think earnings have been very good this quarter, and especially because this is Q4, right? Q4 is generally a very strong quarter, so earnings have been quite good. Last year's Q4 was one of the best earning seasons we had, so so we have a bit of a high base to contend with. I think the numbers so far have been good. Some new surprise earning surprises have definitely come about. Power sector is doing very well, but the valuations I think will make these stocks consolidate for some time. The numbers have been quite decent. Some of them are on full capacity, and the new capacities will come on stream in the next few quarters and stuff like that. But the numbers themselves are good enough for the current prices to sustain, give or take a 15-20% correction in some of these stocks. So I think the numbers so far have been quite good. It is the continuation of the same, themes and sectors which were doing well for the last 2-3 quarters. and the sectors which were not doing well continue to not do well. Whether it is some of the large private banks, the consumption names, they're still not doing well. They've not turned the corner. So nothing, that exciting now because of the valuations, because the markets have, gone up. Of course, there will be pockets and individual stocks which will do well, but broadly speaking, I think it's more of a continuation of what has been happening in the last few quarters.